What's up, everybody? Joe Brown here. This is the Heresy Financial Show, and today we are looking at a paper written by Lawrence Summers. He is the ex-Treasury Secretary, the position that Janet Yellen currently holds. And in this paper, it suggests that the Federal Reserve is basically guaranteed to cause a recession if they actually attack inflation. That there's no way they can possibly achieve a soft landing by going after inflation, given the labor market. Ready? Let's dive in. All right, so this paper was put together by Alex Domash and Lawrence Summers. We can take a look here and we can see Larry Summers. He is an American economist, and he also served as the 71st Secretary of the United States Treasury. That was from 99 to 2001, and plenty of other things that basically don't matter. All right, so if we take a look at this paper, we can see that in the abstract, here's basically what they're saying. Number one, the labor market today is significantly tighter than implied by the unemployment rate. The reason given for this is the amount of quits that are going on and the amount of churn in the labor market. And so they're looking at all the job openings that are out there. They're saying there's a ton of job openings. Wage inflation is going through the roof, and we still have a lot of churn. We still have a lot of people quitting their jobs. So he's saying because of this, because of all these conditions, the unemployment rate, in their point of view, is kind of obsolete. It doesn't really reflect an accurate view of the labor market. So he says, okay, we have to look at how many quits are happening, and we have to look at wage inflation. And if we look at that, we look at the current wage inflation of 6.5%. That is the highest level that they've experienced in the last 40 years. And the last time we had these conditions together was when we had, a sub 2% unemployment rate. And so all the conditions outside of the actual unemployment rate, all of these conditions, last time they were met was decades ago when unemployment was under 2%. So they're looking at this and saying, hey, even though unemployment is really high, the labor market is actually very tight. Now, the reason why that is significant is because high levels of wage inflation they've historically been associated with a substantial risk of recession over the next 1 to 2 years. And all of the past soft landings that the Federal Reserve has said, hey, we succeeded at achieving a soft landing here, they have very little in common right here, little in common with the present condition. So because of these things and a number of other factors we'll look at, there's a very low likelihood that the Federal Reserve can reduce inflation here without causing a significant slowdown in economic activity. Now, the main point to get out of all of this, number one, is that they are right in the conclusion. They've come to the correct conclusion here. It's like in math class, when you get the right answer, but you didn't show your work or you got there the wrong way. That's exactly what's going on here. It is very true that the Federal Reserve is going to try and attack inflation, or they're trying to attempt to look like they're attacking inflation. And number one, it's not going to work. But number two, even if it does succeed in bringing down inflation meaningfully, it will definitely spark a recession and a crash and a decline in economic activity. It's just inevitable. Now, it has nothing to do with the reasons given, which we'll look at here. They're coming at this all from the wrong place, but they still arrive at the right conclusion here. So let's take a look and see what is going on. Inflation is accelerating at the fastest pace in 4 decades. In response, the Federal Reserve moved in March to raise interest rates, and then they planned for 6 more rate hikes this year, potentially more, at 0.25% up to 0.75% at a time. And it says that the Fed is hoping that it can achieve a soft landing without pushing the U.S. economy into a recession. Now, they point out here that the idea that inflation can fall dramatically without a corresponding rise in labor market slack, meaning that unemployment gets worse, runs counter to standard economic theory. Now, what they're referring to here is something called the Phillips curve, which shows the relationship between inflation and employment. Now, the Phillips curve is broken. It doesn't work. It's based off of flawed and incomplete assumptions and calculations about how the economy works. It is complete garbage. Nevertheless, what they're saying here is true. Historically, what the Federal Reserve is trying to achieve is not very likely. And in fact, since 1955, there has never been a quarter with price inflation above 4% and unemployment below 5% that was not followed by a recession within the next 2 years. Let me repeat that. The conditions that we have today, given employment and inflation, since 1955 have never happened without a recession following. So let's take a look at the conditions that the Federal Reserve is working with. Number one, job vacancies per unemployed is higher than it's been in 70 years. That's the amount of job vacancies per every unemployed person, higher than it's been in 70 years. Lots of job openings. Next, we also have worker quits remaining significantly elevated. This is putting pressure on nominal wages. This is why they're saying we should be thinking about US labor markets as extraordinarily tight, because wages are increasing extremely fast, even though they're not increasing as fast as the consumer price index, the inflation rate, the official inflation rate. They are still going up, and there are lots of job openings and lots of quits. And all this momentum means that the expectation is this will continue for some time. So not only is the labor market tight, but we also have the highest levels of wage growth in the past 40 years. So given the broken models and equations that they use, they are saying that they expect wage inflation to surpass 7% by the end of the year. And the concern with that is that it will contribute significantly to underlying price inflation unless productivity rises sharply. Now, what are they hinting at here? This is something called a wage price spiral, where people, they can't afford their standard of living, and so they're able to get a new job that pays them more. They're then able to take that extra money that they're making and use it to buy all the things that they were buying before, maintain their standard of living. But as this happens, more money works its way throughout the economy, bidding up prices even more, and then people find themselves in the exact same position they were in, which means they can no longer afford things, so they have to get a new job yet again. On the employer side of things, you have employers looking at these things as a cost thing. So companies are selling things, they raise their prices in order to compensate for the higher costs. Now they are able to hire people because they increase their revenue, so they're able to hire people at a little bit higher wages so that they can afford to continue to do business. But then now you're having to hire people at those higher prices, so their profits get compressed. So then you end up having to raise your prices again, and then on and on and on it goes. And this is a back and forth self-reinforcing cycle. It's called a wage price spiral, where wages and prices continue to rise, feeding off of each other and push the entire system higher and higher. This is something that contributes to economic decline and a slowdown in economic activity, because all of the wealth is getting sucked out of the system here. And this is not just a theory. We can look back since 2001. The correlation coefficient between wage inflation and price inflation is 0.7. So that doesn't say anything about which way the causation goes. It just shows that wages and prices are tightly correlated in terms of going up together. 0.7, that's a pretty high correlation statistically speaking. You don't tend to see correlations much higher than that. And anytime you do, most of the time you're just measuring the exact same thing. And that's pretty much what's going on here. Wages are just prices. Wages are the price of labor, right? Just as a business has to pay for the cost of materials, the cost of energy, they also have to pay for the cost of labor. When you go and get a job and you get paid for your time or your labor, that's the price that you are charging for your time or your labor. So wages really are just a price. So the Federal Reserve in these conditions is going into this trying to attack inflation. And so what Larry Summers is trying to show here is that from the evidence from the labor market, it is unlikely they're going to be able to do that without increasing economic slack. High levels of wage inflation with the price of wages going up has been associated with a high risk of recession coming soon after. And since 1955, like we said earlier, there's never been a quarter where average wage inflation was above 5% and unemployment was below 5% that was not followed by a recession over the next 2 years. And that's why he was hammering on the actual tightness of the labor market there, because based on all the conditions, we should be looking at the labor market as very tight there, while inflation is very high. Further, there have only been 2 periods where wage inflation fell by more than 1% in a year. It was 73 and 82. Both of those times, were followed by a recession. And then all the times where they said that they had a soft landing, 65, 84, and 94, all of them, the labor markets were substantially less tight than in the present moment. The paper goes on, and I will link it in the description below for anybody who wants to read the whole thing. But essentially, they arrive at the right conclusion that it's impossible for the Federal Reserve to meaningfully reduce inflation without causing a recession. They go about it the wrong way. They're attacking it with the wrong reasons, but they arrive at the correct conclusion here. Basically, what's going on here, what the right answer is, and the right reason for why the Federal Reserve will cause a recession here, has to do with the credit cycle. It's not a business cycle, has nothing to do with free markets. It's not capitalism. It's really centralized control of the economy, central planning. It doesn't work. When you try and bail out an economy from stopping it from having a recession and a crash, like we were supposed to have 2 years ago, and the year before that, and a couple years before that, when you try and stop that from happening, you plant the seeds for further destruction down the road. What you end up doing is you don't allow all of the bad actors, all of the debt, all the malinvestment to get worked out of the system, to get cleansed out. And all you do is you backstop that. And so, number one, there's some moral hazard involved because everybody realizes, hey, I can't fail, so I might as well take more risk. That plants the seeds for more consequences of that risk down the road. The second thing that you do is you artificially expand the money supply. When you artificially expand the money supply, you don't increase the amount of wealth, you just increase the number of dollars necessary to purchase the same amount of wealth. But it causes a fake wealth effect where people feel more wealthy. Companies feel more wealthy, an influx of cash. So all of this spending happens because economic actors look at things and think that the savings pool is large. Interest rates are low. Borrowing is very cheap. The signal is go out there and spend, go out there and invest, and go out there and take risks. Even though that's the wrong thing to do, that's the signal sent to the economy. So the economy goes out and does that. But most economic actors will take this and they'll run with it. And then they'll realize all of that extra money wasn't extra purchasing power. Everybody thought that they had $1,000 of purchasing power. When they went out to try and go spend it over the coming months, they realized they only had $500 worth of purchasing power or less. And so that's what's going on here, that prices rose, and now you have a slowdown of economic activity coming because there wasn't enough capital in the system as much as what the false quantity of money was communicating was actually in the system. And then with these prices getting out of control, now you have the Federal Reserve saying, hey, we're going to rug pull the economy and we have to stop all this inflation, stop these prices from rising. So they're going to start raising interest rates. But what does that do to debt? That means debt now gets paid off, and debt that doesn't get paid off now becomes more expensive when it gets rolled over. That means more and more money is leaving the system to get paid off. So that's a deflationary force, and then it's also getting sucked out of the system to pay the higher debt service cost on the higher interest loans. And so now you have less money able to go towards economic activity. That is all; those are all factors that slow down economic activity. And when you have all of this growth that was built on that false expansion of credit and that false expansion of the money supply, when you start to pull that back and make that go the other way, all you do is start tumbling things over in the other direction. Instead of prices rising rapidly, prices start to collapse rapidly. This works its way throughout the system in multiple stages. Hits asset prices first, then the prices of goods and services, and then wages. And so that's why when all the money came in, you first saw housing prices explode, and you first saw stock prices explode. You saw the asset prices go up. Then, after about a year, you started to see a massive explosion in inflation, in consumer prices of food and energy and the stuff that people need to buy on a daily basis. That's when that stuff started to explode in price. Then you've also seen wages go up, but they're lagging, so they go up at a slower or at a later pace than what the inflation of consumer prices do. So you see the same thing happen on the deflationary side. We're already seeing asset prices like stocks and bonds start to collapse. Next, if it lasts long enough, then we'll see the deflation happen, or at least the slowing down of inflation in consumer goods. And then if they let it go long enough, then you start to see a decrease in wages, and then you get a deflationary recession or potentially depression. And they're never going to let it get that far. They're okay with letting asset prices fall right now until a big player is in trouble, until a globally systemically important bank, large financial institution, or a large corporation deemed too big to fail says, hey, we need a bailout. Once that happens, they'll reverse policy. They're not going to let it get as far as would be actually healthy for the economy to grind to a halt, let all the bad investments, let the recession happen, and cure all of the problems that caused the recession. They won't let it get that far. If they do, that would be the best thing ever. If they find religion and they say, hey, we're just going to let interest rates go through the roof, we're going to let all the unemployment happen, we're going to let prices do whatever they're going to do, we're going to stop printing money, that would be the best thing ever. We'd have a lot of pain short term, but then we'd be able to rebuild on solid footing going forward, and we'd have a much stronger economy going forward. That won't happen. And at the end of the day, these papers by people like Larry Summers, they're all part of the same system. So it doesn't matter whether they're going to cause a recession or not, whether people like this think that they're going to be able to achieve a soft landing or not. We know at the end of the day, the reality is at some point they will cause a crash, they will cause a recession. The only thing that matters is what they will do in response to that crash and that recession. And in my opinion, that is a return to QE, lower rates, and more printing. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.